Good morning and welcome to the Killik & Co market updates. This week, the latest UK inflation data was published and it came in lower than expected. Many had expected inflation to rise or at least stay the same. The reason being that oil is a significant contributor to inflation and the oil price has risen over the last few months. Here's the 5-year chart. You can see it's up from just over $70 in June to over $90 today. A key reason for this is the output cuts from OPEC. Despite the higher oil price, UK inflation dropped from 6.8% in July to 6.7% in August. According to the breakdown of the data, the overall rate was lower because of declines in the inflation rates for household goods and furniture and restaurants and hotels. The lower inflation rate means that interest rates don't need to be as high. So following the publication of the inflation data on Wednesday, the Bank of England opted to leave interest rates on hold on Thursday. This makes holding sterling less attractive. You can see the decline in the pound versus the dollar over the last few months, reflecting falling UK interest rate expectations. This is good news for those already holding dollar assets, as these will now appear to be more valuable when measured in sterling terms. We've also had an interest rate decision from the Federal Reserve in the US this week, and they have also decided to leave interest rates on hold for the time being. However, the accompanying commentary suggested that interest rates might go higher later this year, and also that they might remain high later into 2024. Here's the latest dot plot, which shows where different members of the Federal Reserve Voting Committee expect rates to be this year and in future years. The consensus is that there will be one more rate rise this year. Markets were not happy about the prospect of rates being higher for longer, and the S&P 500 weakened after this Federal Reserve commentary was published. And finally, Walt Disney has announced plans to spend $60 billion on its theme parks. To put that into context, that's more than the entire values of Barclays Bank and Tesco combined. People have been keen to spend on experiences post-COVID, and Disney's parks have clearly been a beneficiary of that. On this chart here, we're comparing the revenue and the operating income, which is a measure of profit, for the Disney media business and the Disney parks business. At the moment, more of the revenue comes from the media business, but more of the profit comes from the parks. Please do give us a call to hear more about our thoughts on Disney. Moving on to have a look at next week, we've got results out from Costco, Accenture and Nike. That's it from us. Have a great weekend and we'll see you next Friday.